Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, June 17th. Pricing across oil and risk assets somehow hide the ongoing tensions in the Middle East. What happens there feels like a ticking bomb and risk persists. So this morning is a little bit more risk off, but we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So stocks in Europe and US rallied yesterday as oil and gold retreated on news that Iran is willing to talk about its nuclear program. The news has been perceived as Iran has no intention to escalate its war with Israel, or it doesn't have means to do so, waning worries that they won't touch the Strait of Hormuz, which actually is the biggest perceived risk to global oil and gas flows as a result of rising tensions in this Israel-Iran conflict, as around 20% of global oil and gas flows transit from there. But US President Donald Trump urged the evacuation of Tehran just a few hours ago, as Israel said that it will continue its airstrike. So it is not your typical de-escalation scenario that's happening right now. It's just a one-sided de-escalation at best. So therefore, risk across energy markets and haven assets remain tilted to the upside. If Iran can't find breathing room, it could make a U-turn and do something in the Strait of Hormuz. So tensions between Russia and Ukraine also remain high these days, remember. As such, natural gas prices jumped nearly 5% at yesterday's trading session and are extending gains this morning at the time I'm talking here, while crude oil prices also rebound this morning. The barrel of US crude is bid above the $70 per barrel level, while Brent remains bid above this 200-day moving average that stands near $71.40 per barrel mark. The top side is seen somehow limited given that the oil market is well supplied today. The US is obviously pumping at record levels, and OPEC Plus brings hundreds of thousands of more barrels back to the market, where the global demand outlook remains gloomy due to trade tensions and the Chinese data remains soft. But again, the global energy supply remains fragile and the supply chains remain very fragile, and it could take just little to disturb the physical flow of oil to reverse sentiment in just a single move. That's the biggest risk, because if you look back in the early part of 1970s, oil seemed abundant as today. Production was strong, demand was healthy, and few out there imagined disruption. Then came the 1973 Arab oil embargo, and practically overnight, the world went from oversupply to panic. So oil prices quadrupled, strategic reserves were born, and energy security became a global obsession. The market had underestimated, in fact, just how quickly a geopolitical shock could reverse the entire supply-demand balance in these fragile energy markets. Then in the 1980s, we saw the opposite kind of shock happening. Demand growth slowed sharply, so that was helped along by fuel efficiency, conservation, and economic shifts, while supply surged from new sources like North Sea and Alaska. OPEC tried to prop up prices by cutting its output, but non-OPEC countries kept pumping. Then in 1986, Saudi Arabia gave up defending oil prices and opened the taps, triggering a full-blown price collapse. So oil fell from around $30 to under $10 per barrel. A decade of cheap oil then followed. So today, we kind of see a mix of both scenarios. Rising oil supply, OPEC abandoning its output restriction plans, gloomy global oil demand due to trade tensions weigh on oil prices, but war in Ukraine and rising geopolitical tensions in the Middle East make energy supply fragile to any possible shock. So that leaves us with two historic templates. One, like the 1970s, where a geopolitical shock actually chokes supply and sends prices soaring. Or two, like in the 1980s, where OPEC discipline frays, a price war erupts and the market crashes under the weight of its own abundance. Which way will the market break? Well, we don't know, obviously, but history tells us this. When oil markets feel safest, they're often sitting on the edge of a major turn. So the latter wouldn't mean sustainably higher oil prices, but a spike is totally a risk that remains on the table. And higher oil prices are obviously bad for global inflation. They rise price pressures and force central banks to hike their interest rates, then higher borrowing costs weigh on growth prospects and weigh on equity valuation. So the level of uncertainty that we have in the market today and the actual risk appetite barely match each other, in my opinion. In the FX market as well, the US dollar remains under pressure this morning as a sign that the market's perception of the geopolitical risks is not yet troubled by the ongoing Middle East tensions somehow. But I personally believe that the Middle East risks are not being correctly or at least fully priced in the market pricing of today. Investors look too relaxed to me faced with such threatening geopolitical headlines. As such, any news of further escalation between Israel and Iran could rapidly boost appetite in the US dollar and also in oil and in gold and other safe havens. And even though the greenback has been battered, literally battered by global trade tensions or triggered by the US, it seems to be holding well when geopolitical tensions mount. Elsewhere, the euro-dollar consolidates gains above the 115 psychological mark, while the Japanese yen gave quite a muted reaction to the Bank of Japan's decision today to maintain its interest rate unchanged and slow the pace of bond tapering as widely expected by analysts out there. The dollar yen is down on the back of broad-based retreat that we see in the US dollar across the board today, but the Japanese 10-year yield is up for a third trading session, which is yet another threat to the global risk sentiment as rising Japanese yields threaten to reverse the yen carry trades and pose a risk to global risk assets, not only to Japanese risk assets, but global risk assets. Note that the rising Japanese yields probably also pushed the US yields higher this morning as well, because the US 10-year yield is trending higher, and that despite the tense geopolitical setup of today. As such, equity futures are in the red this morning at the time I'm talking here, and we could see the S&P 500 reverse its Monday gains later today. Besides geopolitics, the Fed starts its two-day monetary policy meeting today, and even though the Fed officials are not expected to announce any change to their rate policy at this week's meeting, and that's going to be announced tomorrow, the rising geopolitical uncertainties in the Middle East added to the ongoing trade shenanigans and ongoing trade uncertainties make the Fed's decision cloudier than ever. The recent inflation data from the US has been quite soothing, signaling that the price pressures in the US are not mounting as fast as expected by the market due to tariff pressure, but tariffs and a possible spike in energy prices due to the rising tensions in the Middle East today will likely remain on top of the talking points in the Fed meeting and may result in a cautious Federal Reserve stance later tomorrow. So I still could see the financial markets around the world react to any minor dovishness from the Fed announcement this week, as investors are clearly craving to send the S&P 500 and other major indices toward fresh all-time high levels, but there is not much news on the wire these days supporting the risk rally at the moment other than FOMO, the fear of missing out. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.